Hi everybody, welcome to my YouTube channel. Today's video is going to be about negative interest rates, what they mean, how they work, and why they are important in this current climate. For those new to my channel, my name is Chi, and if you haven't already done so, do hit the subscribe button and the notification bell so that you can get an alert for all my new content. To start off with, I'm just going to go through the countries that currently have negative interest rates. The most famous, and I'll explain why later on in the video, has got to be Japan. Then we've got Sweden, Switzerland, Denmark, and the Eurozone. Europe has one central bank that actually governs many countries within that group. In my previous video, I discussed the last rate cut by the Federal Reserve, which is the central bank in the United States. This was what would be described as an emergency cut, because rather than waiting for their meeting, which is what normally happens with central banks, they tell us their decisions about interest rates at their meetings. They decided to go early, and this is as a result of the crisis that we currently see across the world. And the reason why this is very important is because central banks around the world are trying to make a coordinated effort to shore up their economies. So you've got countries that currently have very low interest rates. So for example, in the United Kingdom, the interest rate here is 0.75%. In the United States, it's 1%. And so if action is taken very quickly, you have a situation where potentially interest rates are very close to zero or negative.
And that's why I wanted to bring out this video to just discuss something that's actually unfolding as we speak and could be extremely relevant depending on which country you live in. The goal of lowering interest rates by central banks is one, to stimulate the economy through investments or extra lending, because you can imagine a scenario where it is cheaper for people to take out loans or to remortgage their houses. The idea is that households having extra money would then prompt them to go out and spend. And just if the cost of money, which is what interest rates are known as, is lower, then this could also encourage investments in general. So that's the idea here. When central banks see a recession on the horizon or there's a shock to the system, central banks use their main tool, which is interest rates, to try and boost the economy. As rates are already low in some countries, the question here is, if you're already at zero, or let's just say just above zero, is tipping into negative interest rates a good idea? So we've got some countries that have already done this, but what about the countries like the United Kingdom or the United States, which are those countries that fall into the category of having low but positive interest rates? What are the options that are available to them? Earlier in my video, I talked about Japan. So Japan had negative interest rates in January 2016, and that was at minus 0.1%. And here it was because the central bank was trying to boost the economy, because people in Japan tend to save a lot. And one of the things about lower interest rates is to force people who generally save to actually have no real incentive to keep their money in the bank, and for them to actually look for other ways to get a return on their money. So for example, that could be through some sort of investment in other things which pay you a higher interest rate, but not for your money to just be sat there in an account. So by lowering rates, the people who tend to suffer are savers. But on the flip side of that, the idea behind that is that people are encouraged to spend that money, and then this will drive up demand in the economy. In Japan, people were just saving their money because prices were falling, and this is known as deflation. I will make a video on deflation and why that is so deadly for an economy. Japan has been in that deflationary trap for such a long time, and I'll make a video on that. But in the meantime, if you're interested in inflation and don't really understand what that means, then I'll put a link up for the video that I've made a few weeks ago. But getting back to Japan, what was happening? Prices were falling of goods. So people were thinking, well, why should I spend my money today when actually I can save up, let's say, for 6 months, and I know it's going to be cheaper then? And that is the worst thing that could happen to an economy, because as you can imagine, everything just grinds to a halt. So in order to get people to stop saving as much and to create a boost to the economy, the central bank in Japan took interest rates negative. And really the question remains about whether this has been successful or not. The other point is banks. In my video I did about the Federal Reserve and the emergency rate cut, I talked about liquidity and I talked about banks being the oxygen of an economy, because you've got to remember that banks need to make a profit too, and they generally make profit by charging interest rates. And so when interest rates are very low, this can also act as a tax on banks and therefore impinge on their profits. So when the banking system starts to contract or shrink or is not in a very healthy place, this can have a very detrimental impact on the economy. So lower interest rates can work, but up until a certain point. And negative interest rates are very, very tricky, because at the end of the day, when you save, typically you'll get an interest rate back. But if you had negative interest rates in your country, when you deposit your funds in the bank hoping to get some money back, actually what happens is you're charged for that. And that also works for banks. They have what they are known as reserves, which is money that they keep aside, because at the end of the day, they need to have certain amounts of money for withdrawals and other things as well. And they typically deposit this money at the central bank. And so what happens is when rates are negative, they're also penalized for having reserves. And as I mentioned, this can also have an impact on their profits and their behavior. It would be very interesting to see what happens in the UK and in the US, and when they start to approach zero, whether they go below zero or not. But at the end of the day, if there is a desperate need to stimulate an economy due to an exogenous shock, which is something that actually comes from the outside and wasn't totally expected, which is what we have at the moment. No one foresaw this issue. In January, everyone was thinking everything looked totally fine. And now we're in a situation where we're having emergency rate cuts and people are talking about a recession. So central banks around the world need to act very quickly in a very deliberate fashion. And typically what they do is use interest rates to do that. So if they're already at low interest rates, they can't just wait, they have to do something. The key point here is that you've got certain loans or things like credit cards where the interest rate that's paid on those is very, very different to the rate that I am referring to when I talk about interest rates. It's basically the rates that banks lend to each other. So you could have a situation where, for example, the base rate in the UK is 0.75%, but we know that credit cards charge up until like 30%, for example. So even if we had a situation where rates were lower or negative in the UK, they won't necessarily be passed on to the end consumer. We also need to understand here about banks. So banks are the people who tend to generally suffer in a low interest rate environment or a negative interest rate environment, simply because they rely on high interest rates in order to be able to earn money on their savings as well, and also be able to charge consumers. And I think the biggest question that a lot of people wonder about in terms of negative interest rates is in terms of mortgages. How would they work? Well, we can look to Denmark for that example. They recently launched a negative interest rate mortgage. And what happens is they don't actually pay money back to the end consumer. You still need to make your monthly repayments. But what happens is the amount outstanding gets reduced. In Denmark, it happens to be 0.5%. So every month, your amount outstanding on your mortgage is lower. The flip side of that is that savers generally tend to suffer because, like I said, rather than earning interest on what you put into your bank, you actually have to end up paying the bank. So it's a very messy system. The jury is still out in terms of whether it works or not. Thank you for watching my video. If you enjoyed it or found it helpful, do leave me a comment. It would be great to know whether you actually have a view on negative interest rates, whether you think they're a good idea or not, or even whether you had heard of them before, and now whether this video will get you thinking about what could happen in the country that you live in. And if you haven't already, do hit the subscribe button and the notification bell so that you can get an alert each time I upload a video. And until the next time, take care.